You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. I'm your host, Mark Benzaquen, and once again, today's episode is going to be a two-parter. First, we're going to welcome my friend, colleague, and fellow OIC instructor, Ken Keating, as he's going to build on last month's talk about probability and standard deviation by taking a closer look at various volatility metrics and the concepts of option skew. And then for the second half, we'll listen in on a recent conversation I had with Jay Soloff, lead options analyst at Magnifi, where we discussed how a boy from Kansas made his way up the options ladder and insight that he gained along the way. So that being said, let's kick things off by welcoming my first guest, OIC colleague, fellow instructor here, Ken Keating. Ken, thanks so much for joining me. Welcome back to the Wide World of Options.
Thanks, Mark. It's always good to be here.
Ken, as you know, our colleague Matt was on last month and gave us an introduction to options probability and the concepts of standard deviation, tail risk, etc. And that laid the groundwork for what you're going to be presenting this month at OIC, namely volatility and volatility metrics, amongst other concepts. So let's start with volatility. What is it and why does it matter to investors?
So simply put, volatility are measuring volatility. It's fluctuations in underlying stock prices. So historical volatility is a backward-looking metric that measures how volatile a stock has been in the past. So it's kind of like looking at an electrocardiogram for your stock, okay? Just like an electrocardiogram or an EKG would measure your heartbeat. Historical volatility measures how volatile your stock has been over a period of time in the past. So It's a backward-looking metric. Implied volatility, on the other hand, is a forward-looking metric, and it's anticipating how volatile that stock will be between now and its expiration, and it's doing it through the pricing in the options. So
Okay, historical volatility, rear view mirror look where the stock has been, but it doesn't tell us anything about the future.
Correct.
Implied volatility is kind of the market's future prediction of how volatile the stock may be going forward based on the options price.
Correct. So where historical volatility is backward looking, it doesn't tell you if the stock's going to continue to be volatile in the future. If it's not going to be volatile in the future, it's just telling you what it's done in the past. Implied volatility is on the other hand, forward-looking. It's giving you an idea of how volatile the market's anticipating that stock to be. Now, that doesn't mean just because implied volatility is high that stock is going to be volatile. It's just what the market is pricing. So it could be volatile. It could be not so volatile. So it really just depends. There's no guarantees, obviously. It's just what the market's pricing at that given time.
Right. And when we talk about volatility, implied volatility, forward-looking, we're not saying the stock is going to go up. Implied volatility isn't saying the stock is going to go down. So it's not a predictor of direction. It's just a predictor or a theoretical probability, I guess, of anticipated price movement.
Exactly. It's not directionally biased whatsoever. It could be either price movement up, down, or intraday, up and down.
Right. So. And so when it comes to pricing, a lot of the pricing concepts, the pricing inputs that go into a model are observable. We know what the stock price is. We know our strike price. We know the days till expiration. We know what interest rates, whether or not any dividends are involved. So all of those are quantifiable. They're visible. Implied volatility isn't. Implied volatility is something that the market comes up with to justify an options price, right? So where we can see, some of those inputs, the unquantifiable input is implied volatility.
Correct. So implied volatility is always the wild card, and it's what option traders are always trying to solve for. And it's really based on the supply and the demand for options at any given time. So just like basic economics, when there's greater demand than supply, prices tend to go up. We've all experienced this when you walk in the grocery store these days, and 2 bags of groceries cost you $150, right? So no different than options. So when there's more demand than supply, prices go up. So when prices go up, implied volatility naturally goes up. So when traders speak about implied volatility, all they're really talking about are the level of options prices. So when they say implied volatility is high, what they're inferring is that option prices are high or elevated. And when implied volatility is low, when there's more sellers than buyers of options, implied volatility tends to drift lower, and it's anticipating that price movement is going to be less. So it doesn't mean it's guaranteed to be less or high. It's what the market is expecting at any given time, and it's always fluctuating. It's never static. It's always constantly moving based on the supply and the demand for options.
Gotcha. And I want to come back to that in a second. But when you were on the trading floor, you weren't trading calls and puts. You weren't trading a $3 option. You were trading volatility, right? Isn't as a market maker, that's what you were most concerned with. Where are you running your vols? This $3 put, what vol are you running for it? That's what you guys were really looking at. No?
Right. So it's a way that traders can communicate about options prices. So when I was in a pit standing with my colleagues and we're talking about trades that we did, we'd never say, well, I bought this straddle for $5. I'd always say I bought the straddle for a 32 vol. Because that's how you can describe where the option level is, whether it's low or high, and or I bought a 32 vol and I sold a 65 against it, something like that. So
gotcha.
Yeah,
right. So trading volatility as opposed to trading dollars and cents.
Exactly.
Yeah,
right.
I get that. It's keeping with implied volatility. We're talking about when there's a lot of demand, maybe. That demand for options obviously leads to competition, buyers and sellers, that drives prices up naturally. Are there periods in the market traditionally where volatility may be elevated over the life of an option versus others, earnings, for example?
Absolutely. So typically going into earnings, the market's trying to price an unknown event, right? Everyone's, the earnings are going to come out on a certain date, and nobody knows what that number is. It could be good, it could be bad, it could be just, indifferent. So the market, through the pricing and the options, tends to try and forecast how volatile a stock will be. Now, typically, most stocks move into earnings. Doesn't always happen, but that's why you'll naturally see implied volatility increase as you get closer and closer to the earnings date. So once again, the market is trying to forecast how volatile the stock will be. So when when the pundits on TV talk about, XYZ, it's expected to make a 5% move. It's implied 5% move for earnings. Okay, that's just saying that typically the at-the-money straddle is pricing in a 5% move. So it's a $100 stock. Maybe the at-the-money straddle is trading for $5 with a couple days to go. Mm-hmm. So that's what they're doing. They're taking the at-the-money straddle and coming up with an expected price movement. Now, that doesn't mean that stock is going to move 5%. It could be moving more than 5%. It could move less than 5%. Right. And, and once again, we won't know until the earnings comes out, but the market is pricing a 5% move.
Right. And then once those earnings come out, once the unknown becomes known, now there may be a new expected level of volatility, or that inflated volatility level may drop back down to, closer to where it was before. Revert to the mean is, exactly, the concept that we have. And that's implied volatility crush, right? Now that the unknown is known, there's no longer that expectation of what might happen, because now we know what actually did happen. How does that affect volatility?
So now that the earnings comes out, what was once an unknown event is known. There's no reason for those options to trade at such a high level, so the market reprices everything, and that's when you see this natural vol crush. And typically, prices will gravitate back to where they naturally have been before the earnings. Okay, so but once again, it really gets down to the idea of supply and demand.
Right.
If all of a sudden earnings comes out and a stock makes a big move down, and I've seen this, and you think, well, here comes the vol crush. Sometimes vol pops because traders are thinking, oh my God, the stock missed earnings. It moved. The market was expecting a 5% move. It went down 20%. Now there's a lot of fear in the market, and what else? What next shoe could drop, right? So sometimes volatility increases after earnings. Typically, it does decrease after earnings. There's a vol crush, but there's no guarantee that there's going to be a vol crush. Sometimes volatility does pop depending on what the stock does post-earnings. So,
right.
Yeah.
Right. Good point. Let me ask you this. There's often talk of expensive versus cheap options. And when we talk about expenses versus cheap, we're not talking about the cost of a $10 premium on a call option versus a $2 premium on a call option. We're talking volatility. And it's almost the analogy that I like to use is, housing, for example. You've got, you see a listing for a $500,000 house, 2,500 square feet, 3-bedroom, 2.5 bath, what have you. You really don't know if that $500,000 house, is it expensive or is it cheap? You can't tell just by that number. You need other factors in terms of where's the location. If it's located in a high cost of living area, that house might be cheap. If it's a low cost of living area, that might be expensive. What are the comparable sales, nearby? All of those things go into whether or not that home is priced appropriately. Options are kind of the same thing. The higher the level of volatility, the more expensive it's going to be. But right. You need to know where that volatility is in relation to other things. And that's where these metrics come in that you're going to be talking about, IV rank and IV percentile. What can you tell us about those?
So once again, when you're trading implied volatility, you really want to know what levels that you're buying or selling. And just like anything, you want to buy low, sell high. The last thing you want to do is buy expensive options. You get your forecast right, the stock goes up and you still lose money, right? You want to be aware. And the way you measure how high or low option prices are through looking at implied volatility charts. But there are two metrics that many brokers do offer, and they are called implied volatility percentile and implied volatility
rate.
Yeah. IVR and IV.
Right.
P, right.
And those give us a measure of where current volatility is related to past volatility. So it lets us
Right.
know if the stock's been trading at, if the option, I should say, has been trading at a 20 vol and now it's an 80 vol, that might be considered, that current volatility level might be considered expensive, and therefore it might be a selling opportunity if the
Right.
investor thinks that it's going to drop back down to the normal 20.
Right. As vol is somewhat mean reverting, typically over time, when implied volatility is low, it tends to gravitate higher. And when implied volatility is high, it tends to gravitate lower. Now, depending on what time period you're looking at, you'll look at, so this is what I did when I was a market maker. I'd be looking at implied volatility levels and charts for the issues that I was trading, and I would come up with a buy-sell range, okay? So maybe, just for an example, maybe over a 2-year period, you're looking at implied volatility chart, and the low implied volatility is 20, and the high implied volatility is 60, okay? So I would, my buy-sell range would be, in my mind, when vol gets in the low 20s, I'm more of a buyer, and when it gets in the high 60s or high 50s, 60s, I'm more of a seller. That doesn't mean I'm going to make money, but over time, as vol is mean reverting, over time that should work out, right? Because volatility is mean reverting. So implied volatility ranking is taking those 2 points. It's taking the low point and the high point and comparing where implied volatility is right now. So let's just say the implied volatility low point is 20, the high point is 60. And right now, implied volatility is trading 40. It's right at the midpoint of its high and low range. So we would say that's trading at the 50th percentile. So it's right in the middle. Okay. So it's basically taking 3 points, the low point, the high point, and telling you as a percentage where implied volatility is now. That's IV rank.
IV rank.
IV
okay.
rank.
The two
right.
I always get confused.
I know. They're very similar, but they're also kind of different.
Right.
So an IV ranking of 0 would mean that the current level of implied volatility is the lowest point of the given time period.
Okay.
An implied volatility rank of 100% would tell you that it's trading at the highest level of its given period. Okay.
So if we had, in your scenario, the low point of 20, the high point of 60, current IV is 40, right in the middle, that's going to have an IV rank of 50%.
Right. It's trading at the 50th percentile of its, whatever time period we're looking at. Now, IV percentile kind of tells you the same thing, but in a different way. Instead of taking 3 points, the low point, the high point, and the where it is now, it takes all the given points over a given time period, and it tells you how often the implied volatility has been below that certain level. So if you have an IV percentile of, say, 80, okay, that's telling you that 80% of the time implied volatility has been lower than where it is currently. So it's just another way of measuring and telling you that implied volatility at this point is high or elevated. Now, that doesn't mean you're going to make money by selling high implied volatility, but it's giving you an idea that option prices are expensive, and what strategy it'll dictate what what strategies you want to incorporate depending on your forecast of bullish, bearish, or neutral. So I can tell you personally, I remember trading, and you were on the floor at the same time I was, during the whole internet,
craze and bubble, yeah.
And implied volatility was very elevated, but it was really hard to make money selling implied volatility because the actual stocks, the historical volatility, was moving higher than the implied. So even though if you had sold, very expensive options back then, it was very hard to make money doing it because the stocks were moving around too much. So your intraday hedging of your position ended up costing you money. So back in that weird period, people actually made money being long high implied volatility rather than shorted.
Wow.
And there's a time and a place. Sometimes the model breaks down depending on where we are, what's going on economically or politically or whatever. But there are periods when implied volatility stays elevated for long periods of time, and also when implied volatility stays depressed for long periods of time. So after the internet bubble popped in 2001, the next 2 or 3 years, vol was just really low. And it was very hard. Everything was very inexpensive, but it was hard to make money being long volatility, even though, because vol is low, you think,
Right.
well, I just want to be long volatility here. It was very hard to make money being long volatility for this given period of time.
Yeah.
So, there are no guarantees, but
It's an imperfect science,
Yeah.
but it's definitely concepts for worth investors knowing. Okay, excellent. Ken, excellent information. Certainly thank you for sharing that with us today. And for listeners interested in attending Ken's upcoming May webinars, I encourage you to do so via the events section on our website, optionseducation.org, where you can register for Ken's 2 upcoming May events. Not only is he going to expound on what he shared with us today, but he's also going to talk about more advanced concepts, a deeper dive into volatility, skew, and relative value, among many others. Ken, really, thank you so much for joining us today. Really, really enjoyed it.
well, thank you for having me, Mark. It's always a pleasure to be here.
And now, ladies and gentlemen, we're going to shift gears. We're going to transition and listen into a conversation that I recently had with Jay Soloff, lead options analyst at Magnifi. Jay's been a friend of ours at OIC for years, and I recently caught up with him on the road where we talked about the evolution of options trading and the value of education in the options space. So let's go ahead and take a few minutes and listen in now. All right, everybody, we are coming at you live from the floor of the Money Show Las Vegas Traders Expo, and we're very, very fortunate and honestly very excited to have one of OIC's good friends with us, Jay Soloff, lead options analyst for Magnifi. Jay, thank you so much for stopping by.
Thanks for having me.
Oh, Jay, thank you. Let me ask you, so I know that you had a presentation. I believe it was Evolution of Options, talking about that. Why don't you tell us a little bit about what that presentation entailed and how you felt about it?
Yeah, of course, and it's nice to get in front of people. I do tons of webinars, but there's something different about having a live audience.
The live audience,
Yeah,
right. You can feed off that energy, yeah.
So Evolution of Options Trading is kind of my history lesson on how options developed. I'm super interested in a lot of investment history type stuff, and
Okay.
of course options being an ex-market maker, that's really been my career, has been centered around options. So what I usually do is I talk about how different events in the past have changed how options are priced today, and I think it's important for people to be able to understand the reason options are priced the way they are. So there's enough challenges to become a good trader as there is. So understanding a little bit about the theory behind it without getting too deep into the math. You don't need to know how to calculate Black-Scholes to be a good options trader, but it's kind of nice to understand how volatility sort of developed the way it is, and I think it just helps people put perspective around their trading. So,
Okay. Now, you had mentioned how pricing has evolved, over the years, over the decades. For example, what is an example of that? How do you feel that pricing has evolved? How is pricing different today than it was, say, 20 years ago?
Yeah, and that's like the ultimate question, right? And a lot of that is based around these major events that have occurred. So, for instance, the financial crisis of 2008, 2009, the Lehman moment, where suddenly you have these tail options, right? These really far out of the money options that should be worth zero in theory, right? But they're now suddenly trading at 20 cents, right? And 20 cents is not a big number at all. But if you think about it, it takes a 6 standard deviation move to get there. Why are people actually paying for those things? Well, because we had these events occurred that were never supposed to happen. So now these things have value, and they never had value before. So that's an example I like to use.
So, and when you're talking about tail risk, that's where Skew comes in, yeah?
Absolutely. Yeah.
Okay.
Yeah, absolutely. So I try not to get too deep into Skew, because I think if you're not that familiar with options, then it starts to sound confusing.
Right.
But ultimately, yes, what we're talking about is Skew, and the tail skew and put skew, and to some extent call skew now after things like GameStop, and went from 20 to 500. Now you have these stocks that have call skew. And so I try to bring that in. I try to keep the language not too filled with lingo, but that's generally what I'm talking about.
Okay, I like it. And good turnout, you had said, good engagement, good questions from people.
Definitely.
Yeah, excellent. And I completely agree with you. Speaking live to a physically present audience versus talking, to an audience only on the internet, it's a completely different presentation style, completely different energy in the room. I absolutely love it. All right, let's shift gears, Jay, for a second. So you've been in the business for a long time. I know that you got started in Kansas City, the Board of Trade out there.
Yep.
How did you end up here in Vegas?
Well,
obviously it wasn't a direct line, right?
Yeah, that's, there are several twists and turns along the way. But so I'm from Kansas City, so I started. My degree was from University of Illinois, and I had a degree in economics. So I started in the wheat pit, actually working for the exchange in Kansas City. But I really wanted to learn options, and options were not big on the Kansas City floor. It was mostly a futures exchange.
Right.
And so the people down there were like, if you want to learn options, you need to go to Chicago. I'm like, well, that makes perfect sense for me because I went to University of Illinois. I have a lot of friends up there anyways. So I went up, basically handed out my resume on the floor, and I knew someone who got me down on the floor, handed out resumes, and in an index trading company, SPX traders, they needed a clerk. They hired me. It was, just good timing, right? Like, because you never know who's going to be hiring clerks, and it's generally a lot of knocking on doors at least back
Certainly.
then.
Right.
So I worked with them, and I learned, besides all the regular clerking stuff, just not only all about options, but all about volatility and trading volatility. Eventually, I got on a seat in. By then, we had moved into single stock. So I was in the Amazon, WorldCom. What else was in there? Global Marine, National Semiconductor, a bunch of companies that have since been either are gone or merged. But Amazon was the big one.
Right.
And did that until the .com boom ended and trading kind of dried up. And at that time, I happened to be recruited by this software company that was doing market-making software right when the exchanges were going digital, right, going electronic. So it seemed like a good time to get involved with that. So that took me to New York, to Wall Street for a little bit. I was working with like JP Morgan and some of these banks off the floor. They were basically adopting our software. We ended up being, the company was Acton. We ended up being a good stopgap while companies were developing their internal software. So for a while we were super busy. So I was back and forth from New York to Chicago. So fast forward. Well, all right. So at that point, I'm like, all right, if I'm going to be in this world and not as a trader, I kind of want to get my MBA. It was just kind of random thing that I decided I wanted to do. I wanted to get away from winters, so I applied to Arizona State because it was a decent MBA school in the warmest temperature I could find.
Right.
And, I got in and they flew me out. I'm like, I have to go here. So I came down to Arizona State thinking this was just going to be a temporary thing and I was going to go back into either trading or software or business or whatever. But I ended up meeting my wife at Arizona State, and she's from Arizona, so I decided to stay, and that was really so. This is where we get into the part where I end up in Vegas, right? I couldn't do what I knew how to do in Phoenix, right? This was way before remote working, so I couldn't, trade options. I couldn't work for an options software company. I couldn't do anything that I had a background in.
Right.
So I fumbled around for quite a while until I finally got into the financial publishing industry, which now I've been in for 14 years, where I got to basically talk about options in either newsletter and eventually webinar format, trading services. And my focus has always been mostly on education just because of my background. But it managed to just be a good fit. I ended up being good at it. I didn't know I would be good at presenting or good at writing or any of that stuff, but I learned and I've really never left that industry. And so so the company, Magnifi, now we were since bought by Magnifi, which is a AI assisted investing, which is
interesting.
Yeah, it's a cool product. Where you can basically ask to link your accounts and you can have AI analyze your accounts. But but before that, Investors Alley was the company, and they would always send their people to the Money Show and here in Orlando, and just to talk about our products and talk about options or dividend trading or whatever that we have. And so I've been doing this now for like 6 years.
Well, you like to meet people that are in the space that you're interested in.
Exactly. So,
wonderful.
So now it's not, I don't ever try to sell my products here at all. Like I just come to talk to people, see what people are interested in. I've had 5 subscribers just randomly come up to me and say, "I love your stuff." So it's just it's just good to meet people.
Absolutely.
So that's a long-winded way of getting here.
I like it. I like it. I didn't know about the Arizona State, so that's interesting. Go Sun Devils, right? So let me ask you this. Circle back to your SIBO days, Chicago Board of Options Exchange.
Yeah.
A question that I like to ask people that come on the show, because I remember it so vividly. What was your first impression when you went on the trading floor? Was it, I know for me, I was thinking, boy, I can't believe something like this exists. It was a zoo meets a high school boys' locker room meets an anarchy circus, for lack of a better word. What were your first impressions? What did you think about the floor?
So, at least in the exchange, obviously not the new one now, but the old one, one of the ways in, you would come down that escalator.
Down the escalator, right? From the members lounge, right?
So the first time I did that, you go down and all of a sudden this floor, opens up and
a giant space,
this huge space. But what maybe struck me, besides all the people running around, right, like you said, and the different colors and all that, the technology, right? It looked like a control room for like a NASA, right? You just had monitors and machines everywhere, and you just see all this. I'm like, this is insane. How is all this technology and all these people all in this one massive space? I mean, how does anybody make sense of this? Right? So it was pretty overwhelming, but
exciting.
It's exciting,
incredibly
right?
exciting.
Yeah. So it's overwhelming in this, but you also like, all right, I want to figure this out, right? So it's not overwhelming in a bad way. It's overwhelming in like, oh, this is going to be awesome.
Right. Which it was. It was. We definitely enjoyed being on the floor back in the day. Yeah. Thankfully, I grew out of it.
Yes.
Yeah. All right, Jay, let's go ahead and finish things up. I like to do from time to time, try to catch people off their toes, do a lightning round, and I know that you spent some time in Chicago.
Yep.
Not a true Chicagoan from what I understand or from what I know, but certainly you've been around long enough to understand the Chicago way, as Sean Connery put it back in, the Untouchables. But anyways, lightning round here, Chicago-centric. Let me ask you.
All right.
Willis Tower or Sears Tower?
Always Sears Tower.
Thank goodness for that.
Yeah.
That is the correct answer, by the way. Next question, when it comes to pizza, deep dish or thin crust?
I was always a big Giordano's deep dish fan.
Yeah, I love it. I kind of liken it to tourists, like Times Square is, the saying is that Times Square is for tourists. Chicago deep dish pizza kind of the same way, but that being said, it is delicious. I do appreciate that. So there really is no correct answer with that one. So far you're scoring pretty well. Sports teams, Bulls, Bears, Sox, or Cubs, or Blackhawks?
At least when I was there, I went to many Cubs games. A lot of my friends from University of Illinois were Cubs fans, so I definitely, and they're not in the same division as the Royals, for my home team. So
all right,
so I have to go with Cubs. And the Kansas City didn't have a pro basketball team either, so I never had any issues with the Bulls or hockey. Yeah, and actually, I worked for Blackhawk Financial, so we had season tickets to the Blackhawks.
That's great.
So got to see. So that was fun too. So I really,
okay. All right. So Cubs and Blackhawks.
Cubs and Blackhawks.
All right. Yeah. That also is the correct answer.
Yeah.
Well done. Let's see. Chicago-centric. Ketchup on a hot dog. I'm a little wiffle-waffy on that.
Mustard only.
Yeah. Okay. So let's see, one more. Well, let me ask you this. Favorite Chicago memory? Like, where's a place that, if you had out-of-town guests come in, where would you normally take them? Maybe a nice restaurant. What's your favorite restaurant in Chicago?
Can I say Series?
Well, I don't. Do they serve food other than alcohol?
They had... I would go for breakfast sometimes. Yeah. So if you just wanted like a nice omelet and
right, before the Trading Day series was a place to go. Yeah, excellent. Well, Jay, I got to tell you, you did pretty well in the lightning round. Most of your questions or most of the answers were correct. So well done. You should be pretty proud of yourself on that. I really appreciate you stopping by. Thank you so much.
Yeah, thanks for having me. I really appreciate it.
This was a lot of fun. Let's do it again sometime.
Absolutely.
All right, Jay. Enjoy the rest of your time here at Money Show. I know you've got another great event coming up, so best of luck with that.
Thank you.
All right, Jay. Thank you.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.